Now we're going to look at the fixed overhead variances, and we want to see how we did in terms of spending and what part of that might have been from volume, the increased volume. So the standard for overhead is 75 is 3/4 of an hour at 4. So it matches labor rate, it matches the labor hours, and it's going to be $4 for labor per labor hour, and we use the standard, which is 3/4 of an hour. So $4 times 3/4 of an hour is $3 per unit. So that's what we would have assumed when we made our budget and when we were applying the overhead throughout the month. So now we can look back and see how much overhead was actually used and how close did we come when we applied it, and if we were wrong, where did we go wrong? So when we start with our fixed overhead variance, it's after the period, so we can look at it and say, how much did we really spend on fixed overhead? And according to the problem, they tell us we spent $161,700. All right, so that's our actual fixed overhead, not, based on any rates, not applied. So now we're going to look at our budgeted overhead. In other words, if I had known I was going to actually make 54,000 units, right? In other words, I'm flexing my budget. When I did my budget, I thought I would make 53. I thought I would make, when I did my budget, I thought I was going to make 54,000. And when I actually realized it, I only did 53,000. All right, so standard rate times the actual hours, right? So standard fixed rate is going to be, standard fixed overhead rate is 4, right, times 70, the actual standard, times 54,000, right, because that's what I thought I was going to do. Using my practical volume, I thought I was going to do 54,000. So $4 times 0.75 times 54,000 ends up being 162. All right. So there's my budgeted, there's my actual, there's my budgeted. And what did I apply? So as I was making the actual things, and I'm applying it based on my standard hours, right? What did I apply? I would have applied $39,750, right? Which we calculated over here, right? The standard hours that we calculated, 39,750, right? If I had known I was going to make 53,000, right? I didn't. I thought I was going to make 54, but I actually made 53. So if I'd known I was going to make 53,000, what would my standard hours have been? So, they would have been 39,750. So 4 times 39,750 times 0.75, right? 4 times 0.75 times 3750 equals 159,000. All right, so $4 times 0.75 times 3750 is 159,000. So now we can figure out the differences between these. So the difference between your actual fixed overhead and your budgeted fixed overhead is your spending variance. 161.7 minus 162 is equal to 300, and that's a favorable variance because you spent less, right? And spending less on an expense increases your net income, so it's net income increasing, so that's a favorable variance. On the volume variance, what we're trying to get at is how did that change in the volume change our overhead, not related to the costs. So volume variance, 162 minus 159 is equal to 3,000, and that's unfavorable, right? Because we actually spent more, and so that means that was income decreasing. All right, so budgeted was 162, and what we applied was less than what we actually would have spent. All right, so unfavorable. All right, so that's fixed overhead, and we will go on to variable overhead, and then we'll be done with our variances.